me do this before, but if it's the first time, I'm kind of give you a preamble of why it's important, what's its usefulness to it. I can predict where my future PD arrays are going to form. Now, this is something that I can transfer to you, but I already know where fair value gaps are going to form before the dealing range even forms. And I know that's hard to believe, but that's the superpower ICT has. So, and I know that's going to cause a lot of static, and people are going to put sound bites about it. This is where he said, "Yep," and you're going to talk about me, and people are going to come to the channel and they're going to learn. That's how it works. So here's your dealing range, okay? And equilibrium is the halfway point right here. So ideally, your best entries, lowest risk, highest yield in terms of R multiples, is going to be entered on a long at or below this line. Pyramiding has to be limited to this price level here or lower. Now, is that ambiguous? Is there a lot of moving parts to that? Nope, it's very simple, straightforward. Now, how can we use this information to pick the right fair value gaps? How can we use this information to pick the right order blocks? Oh man, you're gonna have to come back on Monday for me to get to that. I'm just kidding. You were pissed off for a second. Oh no! I love my job. Here we have the upper and lower quadrants. Okay, and this is when you want to take a picture. You can see that these are my quadrant levels. Optimal trade entry level here. This, when I need to pull up the OTE, I just change the 0.75 to 0.725 or 0.79 because I round it. I don't do the 78% returns. I do 79%. And then the rest are, these are over here. These are extensions that they're not going to be taught to you until they're in the book format. It's using the opening range, gap, and standard deviations. So it kind of picks the high and low of the day. And I know that's a little cliffhanger for you too, but what we're seeing here is the quadrants that is grading this dealing range from the high down to that low. Now, think about it. Yesterday, I took your attention and told you to start focusing on the relative equal highs where everything was left smooth in the marketplace. That's our bias, it's bullish. So that means we're going to be looking for draws on liquidity for buy side. We're not interested in shorts. So that means you're going to look for bullish order blocks. It means you're going to look for bullish breakers. It means you're going to look for bullish fair value gaps, or you're going to look for fair value gaps that were initially characterized as what would be short selling or premium that's going to be broken and then treated as an inversion fair value gap. You see how everything changes to, these are usable PD arrays. These are reference points that now you can suddenly build an idea or an expectation around versus every down closed candle should be an order block. It's not. It's not. So at 8:30, the algorithm kicks in whether there's news or not, but we had medium impact news driver this morning. So at 8:30, the market trades into our discount array, and then we wait for what? Displacement. We don't just go down here and start buying just because it's trading there. Let the algorithm tip its hand to you. Let the market say, listen, I'm going to show you what I'm about to do. Pay attention. So the market goes above the short-term high here. What makes this candlestick important? It's lower high here and it's lower high here. So that's a swing high. So when the market breaks above that, that's a shift in market structure. So we can see it as such. So that's a shift in market structure. Go back and look at model 2022 mentorship videos and you'll see it's very similar to that. And then it displaces higher. And then we have another swing high. This candlestick's high is lower than that one. And then the lower high on this one. So there's a swing high there. And it broke both of them. Leaving what? This buy side imbalance, sell side inefficiency. A portion of the order block or a portion of the fair value gap must, listen folks, listen, okay? It must be at or below the quadrant level. Here's your lower quadrant level. Here's your fair value gap. Is this fair value gap at or below the lower quadrant? Yes. That means that this fair value gap is a proper candidate to be long when you're bullish. When time, 8:30, spooling at 8:30, that's the only 30-minute delineator for a macro. Everything else is 3:15 to 3:45 for the last hour trading, and then you have the uh, first 10 minutes to the top of the hour and the first 10 minutes after the top of the hour. That's every hour macro. Okay, so there's your little skinny on the macros. But 8:30, whether there's news or not, the algorithm will start spooling. If it doesn't start spooling and running, then you just simply wait because it's telling you that it's waiting for the 9:30 opening bell. So what happens if you're anticipating something here and just meanders around or goes lower? Do nothing. Sit still and wait for the 9:30 opening bell. But because I built the case around everything I'm talking about today, see, we're already inside of the equivalent of 2 chapters in a book just with this live stream. Just this live stream talking about the impacts of knowing how to use the economic calendar, knowing how to use the day of week phenomenon, understanding the pools of liquidity and the PD array matrix, and how to now use that information and define which order block, which fair value gaps are the one I trade off of, because that's the one the algorithm's going to use. That's authorship. That's fingerprints. Okay. By defining this with the quadrant level here, your fair value gap or order block, which is this down closed candle right there, is that below that quadrant level? Yes. Yes. Is this fair value gap at or less than this quadrant level of this dealing range? Yes. Now watch what happens. The market trades down. We have a little bit of a mohawk. That's fine because you have an order block there. That order block right here. Why am I using that one? Why am I specifically using that one? Because it has the lowest down close in with a body. So the body's projection lower, it's lower, and we don't use this wick. This is your order block right there. So half of that order block is a mean threshold reference point. It's not consequent encroachment. Consequent encroachment is gaps or inefficiencies or wicks. Okay. When it's a candlestick body, in this case it's a bullish order block, half of that range is mean threshold. That price is 452.75. What's the low of that candlestick? The fucking low of 452.75. Folks, that's perfection. Elliott Wave wishes he fucking knew this. Sam Seiden has no idea how to fucking do that. No idea. Well, maybe he does now. He's watching my videos and stuff. But there is no other school of thought that teaches that. None. Wyckoff has no fucking idea. No idea. He's rolling around in his grave right now, wishing he had a fucking pen and pad right now. I wish I would have put that in my writings then. He didn't know about it. Okay? And everybody that uses Wyckoff, they don't have this information in there. Sorry. But that's perfect to the tick. But that's supposed to be buying and selling pressure, right? Buying and selling pressure on the next candlestick right there. What's the candlestick's low there? 20,452.75. Not one deviation off by one tick less or above that value perfectly delivered. And you're going to tell me, you're going to argue with me that it's buying and selling pressure, the randomness of everybody coming together and buying and selling on their bullshit that's going to cause the market to stop right there, right? You know, it takes more faith to believe that than it's simply that there's an autonomous price engine that literally is controlling the fluctuations in the ebb and flow until it's manually disturbed by intervention. That's what's going on. And you can argue with me all you want, but you're never going to convince the author. You're never going to convince me, and you're never going to convince my students have now seen it, they use it, they make money with it. They can predict it, they can anticipate, they can see it. And some of them have communities where they're doing it in the witness of others continuously. And you're never going to convince them that they didn't witness it. Not just once, not once in a blue moon, every fucking day. Now find that in anything else out there. It's not. So the market does what? It rallies back up, and look what it does. It delivers into this volume imbalance. See that? So this volume imbalance, it delivers it. What's it missing? Buy side and sell side delivery. So it lays a body up in there. So it buries a body inside that volume imbalance and then drops right back down into what? That swing high here. Rallies back up, leaves the lower quadrant, trades up to equilibrium, meanders around in here, and then causes what? Another displacement. What is this candlestick right there? What is that? It's a fair value gap. Well, ICT, why didn't you use this one? See, he doesn't even use his own logic. He doesn't even use his own stuff. He's making it up as he goes along. Why didn't he use that fair value gap, ICT? Why aren't you using that? Because isn't that a fair value gap? Isn't that a buy side and sell side efficiency? Ain't that the thing? Ain't that the thing? No, because where's that? The majority of the body of that buy side and sell side efficiency is what? Above that quadrant. Uh-oh. Starting to make sense now, isn't it? So here we have what? Equilibrium. We're at that we're at that precipice where if you're building a position in all this down here, pyramiding, like you've seen me do many, many times, we're at that halfway point of that dealing range. So that means you have to do all of your business at that price range here or less if you're going to be pyramiding. Otherwise, if you start adding up in here or above it, you're really just tossing good money after potentially you might see a retracement. Even though it's low resistance liquidity runs, meaning that we're not getting a whole lot of deep retracements. What's a characteristic of low resistance liquidity runs? Do you remember? Do you remember what it is? Down closed candles will support price higher, and inefficiencies will leave a portion open. Is that hard to remember? I've already said it before, but you probably forgot. But now this is the time when you write it down in your journal. Every day, when you first start your day, have that written down in front of you on your notepad. High resistance liquidity runs are going to see a lot of give and take back and forth, and every fair value gap will be closed in. Remember, if it's spending a lot of time in the inefficiencies, what is it doing? It's telling you what? We're inside of high resistance. That means it's going to be problematic for you. You're not going to be comfortable in it. It's going to be back and forth price action. Don't run your stop loss up real quick to break even. Just let it move or don't trade. That's the characteristics with it. So in here, we are in close proximity to equilibrium from the dealing range high, dealing range low. We've already accumulated down here, rallied up, equilibrium, retracement, and then displacement here. So we are seeing this fair value gap dead in the middle, consequent encroachment. We can now take that also. So because it's laying inside of equilibrium and half of that gap is basically overlapping that blue line, which is equilibrium of the dealing range, when you're bullish, how could you use that? Now you can try to put a limit order to buy right at the midpoint, trusting that it's going to leave the lower portion open. Notice how it left this down here open? What is that? It's a breakaway gap. This is a tradable fair value gap. But because the consequent encroachment of this gap, which is this, watch. That's this line right here, okay? It's overlapping with the equilibrium price point or middle of the high to that low. So it's a convergence of two factors of equilibrium or midpoint. So this is where a institutional order flow entry drill would be optimal because you would expect what? Only a partial entry into that blue shaded area or fair value gap. Trust me, my charter members are flipping out right now because they were never taught this. You're learning it with them. So this is institutional order flow entry drill. And just because my watermark is not on this video, if you upload it on your channel to try to make ad revenue of it, I'm going to yank it down and put a copyright strike against it. And if it's a channel you're already making ad revenue off of, it's going to hurt you. So don't do that. You don't have my permission. So this is institutional order flow entry drill. Or you can use the upper quadrant of this range, and that would be done like this. And you would use that price plus one tick, that 462 and 3/4 plus one tick. And that would be your entry. That would basically give you a very specific, not a zone entry, a very specific price level that would constitute an institutional order flow entry drill. Institutional order flow entry drill is a entry model where you're expecting a fair value gap to be traded into, but not fully close in. And because you're expecting low resistance liquidity run conditions today, because of all the things I talked about in the first quarter of the or first half of this lecture today, all those things building and coalescing with the idea that it's going to be a large range day, it's going to be explosive at the opening. Any opening range gap should not be expected to be traded to, even though there's a 70% likelihood that half the gap should be repriced to in the first 30 minutes. Throw that to the sidelines and expect them to just really make a mad dash to get to the liquidity that we've outlined. So low resistance liquidity run entries in here, low resistance liquidity run entries here, and then this is a gap that is what? Below the upper quadrant. And this is where I would use to see if I'm on side. Now, you can take that and enter on it. There's nothing saying that you can't use that as a model. I'm not saying that I'd be comfortable doing that. I could do it, but because I have to have principles and protocols and procedures to follow, because otherwise I'm left to my flesh, and my flesh will do like it did yesterday and put me in things that I shouldn't be doing. So when I try to fancy dance and finesse my own stuff and try to let my own experience dictate what I should do versus the process, the protocol, the model, the rules, stay on the right side of the road. Don't cross the yellow line, Michael. Well, if you're listening to me, your trading ends on the entries here or less. Anything above it, you're just using it for management purposes. So when this fair value gap forms, this is a valid fair value gap, but it should not fully close in. Why? Because we're in low resistance liquidity run conditions. We're in an early session of a potential large range day that's bullish, and we're at the quadrant, upper quadrant, and less. See that? So what does that create in here? This candlestick's low. That's an institutional order flow entry drill. That's an institutional order flow entry drill. That's an institutional order flow entry drill. Leaving what? Portion of the range open. That is telling you continuous feedback that yes, down close candles consecutively, that's an order block. Draw that out in time. Hits it. Does it support price? Yes. In and of it by itself? Nope. Half of this gap at equilibrium and an order block, this portion should stay open. It should not trade back down to this one because that's a breakaway gap. All those things are signatures and characteristic of low resistance liquidity runs. Folks, there's nobody else that's taught that stuff. And that's the stuff that I didn't know that I needed to know. Because when I trade in these environments, it's flawless. That's why when you watch my executions, you're like, what in the hell? And you see my stop losses and they're ultra tight and I'm sitting comfortably and they're getting real close to it. I'm not worried about it. I'll add right there. I just shared it with the other day. I added right into it. When it was getting close to my stop loss, more, because I know your jaws would hit the floor. And then all the comments that came behind that trade. What in the hell? Yeah, because I'm using what I'm showing you right here. When you enter in here, your stop loss can be just below this candlestick's high because it's not going to go down to the lower bottom of that fair value gap because we're in low resistance liquidity runs. The algorithm is controlling this. So if you know what the mechanism is going to be when it is seeing these things based on defining your dealing range, knowing where equilibrium is, if you're bullish, you're buying at it or below it, in every fair value gap, or in this case, order block. Isn't this an order block? Down close candle, down close candle. Two consecutive down close candles, that's all one range. It's doing what? It's delivering price lower. Does that down close candle support price going higher when it comes back down to it here? Yes. Then price goes where? Higher. Down close candles here. 1, 2, 3. And then it creates that final institutional order flow entry drill like it did here in this range here, going right below the high of the fair value gap. Same thing here. This candlestick's low. That's the high of this blue shaded area where fair value gap. So it's trading back down into that. But isn't that also reaching into, I lost my train of thought, the order block supporting price, right? When we're seeing price trade down into it, this candlestick here, isn't that an order block? Isn't a down close candle when price is moving higher? Inside that candlestick's range, it's trading down into it. And it's rare that it does this, but sometimes it will. It'll trade to the low of the candlestick. I don't like that. I would never enter on a trade like that. I want to see half of a bullish order block, the mean threshold or higher to its high. I want to see price use that portion of it to trade down into and then repel price away. When you're looking for dojis or tails beneath the candlestick, like we're saying here and here, those are forming inside order blocks or inside fair value gaps. When the order flow is bullish, you can anticipate these things forming. That's why when you look at my entries, I'm always entering on the very lowest candle or the one candle before or the one candle after the lowest candle when I'm bullish. Don't take my word for it. Go back and look at every example I've showed when I'm executing with live data, no market replay. I'm using what I'm teaching you right here. Now the market then leaves this range and breaks above the dealing range here, and then we're going into what? We're going into that 9 o'clock hour, and we trade up into new week opening gap here. Um, I almost said something that would have been a little too crude, not in the sense that it would have been vulgar, but I was always mention someone's name, but they're probably watching and they know I mentioned this price level, 20,495. I mentioned that yesterday. That was my target, and it hit there. I prompted them when it hit too, by the way. Um, we traded up to just short of consequent encroachment of the new week opening gap. Now this is current new week opening gap. Notice I don't have 1,000 different new week opening gaps. I don't have every new day opening gap on my chart. Some of you are leaving comments saying that I am so confused. I have all these lines on my chart because you're trying to put everything that's in the kitchen sink in front of you. And I don't do that. All you need, sincerely, all you need is a draw on liquidity. That might be a session high. That means like a morning session or a PM session from the previous day, a London session high or low, an Asian session high or low. Wherever you think the market's going to gravitate to for the purposes of tapping in and engaging liquidity, where is it smooth? Where is there a single high? Because it isn't always relative equal highs and relative equal lows. That's just the easy things that a new student I've learned that it's very easy for them to spot that. Just like a fair value gap, you can see there's gaps, but you just don't know. Now you know how I formulate an idea around the fair value gap that I want to trade on. Just because it's a gap doesn't mean that's the one I'm trading. And that's why these yahoos out there will say, "Oh, it's running through the fair value gap," because you're a fucking idiot. You don't know what you're talking about. You're listening to other people that ripped me off, and they're running mentorships, teaching people for pay monthly fees when they don't themselves know what the hell they're doing. They have no idea what they're doing. But watch and see how this all finds its way into their mentorships now. Watch and see, and you still don't have the half of it.